Yeah, I mean, today it felt defensive all day long. And as you guys have been talking about, it's the China tension, certainly. It's also the Trump executive order on the internet names. I'm pleased that they actually didn't fall more today. What to me is the most interesting, Wilf, is that the economic data today was really lousy, really crummy, and yet bond yields actually were up on the day. The 10-year actually up a little bit. And that suggests to me that people believe that we're at the worst in terms of the economic data points. And as you reopen the economy, you're going to start getting better data points. You're going to get better growth. And so that's why value actually has been outperforming in the most recent days. I still think you want to own a barbell of some growth, some technology. The secular stories are just too compelling in AI, cloud, security, etc. But you definitely want to own some cyclicals because we are starting to get some data points from some companies like Toll Brothers yesterday talking about deposits up 13%, the best since 2005. GE's Larry Culp even said healthcare utilization rates are stabilizing. So watch Boeing and them restarting the production of the 737 MAX. Watch the auto production restarting because that's going to have a meaningful impact on at least the manufacturing part of the economy going forward.
Sarah, we can hear you, but we can't see you. Hopefully fully operational in just a moment. Meantime, Novartis partnering with Harvard to manufacture a coronavirus vaccine. Meg Terrell's got those details for us. Hey, Meg.
Hey, Wilf. Well, another giant company jumping into the COVID-19 vaccine race. Novartis has agreed to manufacture a vaccine developed by researchers at Harvard, Mass Pioneer, and Mass General at no cost. Now, this is an interesting partnership because this vaccine technology is based on the same delivery mechanism that's behind Novartis's gene therapy. That's one of the only gene therapies that's approved. Now, together, they say they do expect human trials to start in the second half of 2020. So a new modality here joining the many companies already in the race for a COVID-19 vaccine, Wilf.
Meg, thanks so much for that. Mike, to pivot to you on this, I mean, healthcare stocks, again, up today, having been strong more broadly this year as opposed to the prior couple of days this week. But another big announcement from another big pharma company. It again kind of raises the question as to can all of these companies that have performed so well really make that much money off this, or is there only going to be one winner, or is it only going to be companies that may produce the vaccines, but they won't make huge profit from them?
Yeah, it's actually unclear that the market is even attempting to answer those questions. Well, I think the bottom line is no, this is not necessarily going to be a multi-year, extremely profitable enterprise, these particular vaccine efforts, but the general perception of a ton of money being thrown at a lot of these companies, big and small, with products and without, is just a tailwind to the general enterprise. And biotech also, because it's got this secular growth dynamic to it and wasn't very cyclical, was participating along with tech just for kind of fund flow and stylistic reasons, as opposed to people making a call on exactly what the outcomes of some of these trials is going to be.
We are currently down about 1/3% on the S&P with 5 and a bit minutes left. Let's get a check on retail. BJ's, Lowe's and Target posting strong comp store sales, more than 10% in the first quarter. And some retail companies are striking an optimistic tone for what's ahead as the economy reopens. Burlington Store saying there's clearly pent-up demand. Dollar General saying since the end of the first quarter, the company has continued to experience elevated demand in its stores. And here's Dollar Tree CEO Gary Philbin on Squawk on the Street earlier today.
We're building this for the long term, and we'll navigate through the balance of this year first, and then I think it's going to suit us better going into next year, knowing that customers are going to be probably tight on budgets, needing value, needing convenience, and I would even add in feeling safe in a small box environment. So I think those things work in our favor.
To that, we could add in some constructive comments from some of the consumer-facing banks this week, like J.P. Morgan and Bank of America. Steph, how much positivity do you take from comments like that?
I take a lot of it because they're at the front line, right, seeing it every day. And the comments about May from just about every company so far, from a Dollar Tree, from a MasterCard, from a PayPal, from Bank of America, Brian Moynihan, they're all saying May on the consumer side is actually doing a bit better on a month-over-month basis. Certainly nowhere where we want to be, but I do think we're gradually making baby steps. Those companies, especially on the discretionary retail side, if they have consumable exposure, they're hitting it out of the park. I mean, this is why Family Dollar had 15% comp in their quarter, because 80% of what they sell is consumables. But what will be interesting to me is as we get through this, there's going to be a mix shift again towards more discretionary items. And that is when the margin story can actually inflect higher for these companies. That's why I like Target out of all of these at this point and still remain a buyer there.
Gary Philbin said the exact thing, that he's starting to see that shift from the staples to the more discretionary items that people are buying. I'm back. And I want to talk about the home builders, because despite data today showing a nearly 22% fall in pending home sales, those home builder stocks have significantly outperformed the broader market over the past month. And Credit Suisse believes the sector still has some room to rally. The firm initiating the home builders today saying that more millennials are looking to buy homes, coupled with underbuilding across the U.S. And that's created significant pent-up demand in the housing market. Credit Suisse likes stocks with entry-level housing exposure and strong balance sheets like D.R. Horton, Meritage Homes, and KB Homes. Stephanie, you've been in, I think, D.R. Horton, correct? Do you think that we've already seen the bulk of this move, or are you bullish like Credit Suisse, like it can continue?
I mean, the D.R. Horton is up 103% from its March lows, so it certainly has recovered quite a bit. But it is definitely one of the stronger companies in the industry. And if you have millennials being 38% of home buyers, that's a nice tailwind. Then you have, coupled with low interest rates and underbuilding, I think that the supply-demand story is really very favorable. D.R. Horton has the best balance sheet. It's very land light. It had a very good quarter in terms of market share growth, and it's trading at 11 times earnings. So I think you want to pick and choose where you want to buy, but this one is a high quality name, and certainly if you were to see a pullback on this name is one that I would be buying.